Let's face it, having a good credit score gives you more options when it comes time to applying for loans, cheaper insurance premiums, as well as a greater chance of approval from credit cards and other forms of credit. Credit scores have been around for a while, and that's why it's so important to take the necessary steps to improve them. In this video, I'll break down the Share Secure Loan technique, which can help increase your credit. What's up, winners? My name is Naam. If you're new here, welcome. Here we talk all things personal finance and credit. Start now by subscribing so you don't miss out on any future videos. Now, this brings me to the method that I wanted to share with you, which is the Share Secure Loan technique. The key idea behind the strategy is to get a share secured or secure installment loan on your credit profile. Then once you have done that, the goal is to pay off most of it so you just owe less than 9% of the original loan amount. Then all you would have to do is keep the loan open for the whole term of the loan, which can range anywhere between 3 to 5 years. Wait, I gotta get a loan for 5 years? Well, yeah, I swear it's much simpler than you think, like getting 2 free stocks with Webull when you deposit $100. But seriously, what exactly is a share secured loan? All this is a type of loan where your savings will be used as collateral in case if you default on the loan. Most banks and credit lenders are very open to doing this since money is already there in the account. The truth of the matter is, some of the most popular loans out there are secure loans, such as mortgages and car loans. If you ever default on a car loan, they can take it. They can then sell it at auction and try to make up the difference of what you owe them. But with a share secure loan, this one is much more solid because it's backed by money that you already have in a savings account with the lender. The money that's in the savings account will be frozen until the loan is paid back, leaving no risk for the bank. So as the loan payments are being made and your balance becomes less and less, the money becomes slowly unfrozen and then it can be used. For example, you pay off $100, you get back $100. The great thing about these loans is that some banks and credit unions may not even do a hard pull, since the money is already 100% guaranteed in a savings account. To understand why the SSL technique works is that you first need to understand credit scores. The most commonly used credit scores will be from FICO. This is the credit model that 90% of all lenders and creditors take into consideration when determining your approval. So inside of the FICO score algorithm, there are 5 main parts. 35% of your score is payment history, 30% is the amounts owed, 15% is the length of credit history, 10% is new credit, and another 10% is credit mix. The 2 largest key factors when determining your credit score will be your payment history and the amounts owed. The key reason why this technique works so well is that it helps with your payment history, your amounts owed, and your credit mix. Credit mix is something that's often overlooked by many people, which I understand because it only takes 10% of your credit score. But to break the 800 levels, you're gonna need to do well in all 5 sections. All credit mix is types of credit that you do have. This can include a mix of credit cards, retail accounts, installment loans, and mortgages. If all of your active accounts are only of one type, such as credit cards, this will give you very low points for this particular category. To get the most out of your credit mix, you want to show that you're able to manage different types of credit. Again, since your credit mix is only 10% of your FICO score, this will not be the end all of getting a loan or a mortgage. Other factors play a role like income, debts, and other data points. But if you want the highest possible credit score, you're gonna need some diversity in your accounts. The majority of people who are watching this video probably have at least one credit card. Let it be a secure card or a traditional unsecured credit card. If you wanna get the most out of the credit mix category, you're gonna need at least one installment loan. Additionally, there has been some evidence that some FICO scoring models take into account open loans way more compared to closed loans. So the fact that this technique adds an open installment line of credit, it is definitely an added benefit. So now let's talk about the big boy, which is the amounts owed category that takes up 30% of your FICO credit score. This category is often confused with just credit utilization. Credit utilization is just a subcategory of this category. The amounts owed category takes more into account. The 5 key factors are the amounts owed on all accounts, the amounts owed on different types of accounts, how many accounts have balances, credit utilization on revolving accounts, and how much of an installment loan amount is still owed compared to the original amount. The last factor is where this technique does its magic. If you have any open installment amounts that are smaller than what you owe, the better off your credit score will be. It's similar to credit utilization, so let me give you an example. Let's just say that you have a $1,000 loan, but you currently owe $900. For this example, you have a 90% installment utilization rate. Having high balances generally does not help with your credit. As your installment lines of credit, such as your student loans, mortgages, auto loans, becomes less and less, this is when you will reap the most benefits from this category. Additionally, since you'll be keeping this loan anywhere between 3 to 5 years, your payment history will further get improved. Again, as long as you make payments on time. With this technique, since you're paying most of the balance right away, even if you were to set it on autopay, a small amount will keep this account reporting positive. Now, who will benefit from this technique the most? This will work best for individuals who have no installment lines of credit whatsoever, meaning that you never had a loan, no previous mortgages, auto loans, student loans, or something similar to that. This will also help people who have had an installment loan but is now closed and no other open installment lines of credit. On the other hand, here are some people who will not benefit from this technique. People who currently have an open installment loan, individuals who are looking to improve their credit score fast, meaning like less than 60 days, people who do not have enough money to open up a savings account or in savings, and individuals who have unrealistic outcomes on increasing their credit score. It is safe to say that you should expect around a 30-point increase after a few months. There are some other ways to help your credit score much more. Paying off your credit card balances will increase your credit score faster and sooner. Also, getting negatives or delinquencies removed from your credit report would definitely help. So those two techniques will definitely increase your credit score faster in the short term. But if you're looking at the bigger picture, like long term, trying to grow your credit score past 800, having a long length of payment history and diversity in the type of accounts that you do have will surely help. One thing that you have to keep in mind is the average age of accounts. Anytime that you do get something new on your credit report, your average age of accounts will go down. And this will cause your score to drop down a little bit. But this is something that you should really not worry about. The length of credit only plays a small role of your overall score. So even if it were to drop a little bit, you'll get your average age of accounts up within a few months. The thing about credit is that you gotta play the game right. If you don't play into the system, then you're just leaving money on the table. Naam, this is all great, but will this help with every type of credit score? The SSL technique will most likely help you out with FICO 8, which is the most commonly used one amongst credit card companies and lenders. This may not work with FICO 9 or 10, even though these scoring models are newer. Now let's break down the process. The first thing that you need to know is that you need to have enough savings to initiate this type of loan. You really can't get a share secure loan without having any savings. There are other companies such as Self or Grain that lets you get a secure loan without any money up front. So I'll have the video up here if you guys are interested. For this technique to work, you're gonna need to have at least a few $100s or even a couple of $1,000s inside your savings account. But even though this does sound a lot, I'll show you how to get most of this money back right away. The next thing that you have to be aware of is that this is still a loan. So you need to have a high enough credit score so you can limit the amount of interest that you would have to pay. Preferably, it is best to have a credit score of 680 and above, but again, each credit union and bank will have their own criteria. Since the collateral is your savings, the requirements may be much less. The third thing that you want to do is contact your own personal bank or credit union to see if they offer share secure loans. Sometimes this is also known as a savings secure loan or simply just a secured loan. It may be difficult to apply for one of these loans online, so you may have to go in person or contact customer service. If they do not, then you have to find a credit union or a bank that allows you to do so. There are only a handful of credit unions out there that offer this type of loan without doing a hard inquiry, because some will. At the making of this video, I know that for sure that Navy Federal Credit Union and SSFCU does not. But things do change. If you do qualify for one of these credit unions, just ensure that they do offer a share secure loan without a hard inquiry. The thing about credit unions is that you first have to become a member. Some are a little bit more strict than others, so you gotta do some research whether or not you qualify. But even if your local lender does not offer a share secure loan, an unsecured loan should work as well. Alright, so to maximize this technique, you would want the smallest loan for the longest period of time. Back in the day, you were able to get a $500 loan for 60 months. Can you imagine? That's roughly around $8 per month, not including interest. But anywho, it may be difficult to find a small loan like that with those terms, so it really just depends on the lender. So let me give you an example. Let's just say that you have $2,000 in savings. You didn't call customer service over the phone and ask them that you would like to apply for a share secure loan. Here are a few questions that you need to ask to see if this trick will work. The first one is that can you make larger payments than your monthly minimum? And will it apply the excess to the remaining payments and makes your next month payment optional since you made a large payment? And hopefully they say yes. The next question you want to ask is that by opening a checking or savings account, will this result in a hard or a soft pull? Remember that a soft pull has no negative effects. It's best to have a soft pull only, but a hard pull will be okay too if you don't have that many. Another question is that by opening an SSL result in a hard or a soft pull, since it's secured by your own funds, so hopefully they say no. Another question to ask is what is the minimum terms for a 60-month loan and how much you need in savings. The longer the term, the better, and the least amount, the better. And lastly, are there any fees associated with opening this type of loan? So hopefully they say none. Once you have asked all these questions and you like the answers, go ahead and apply for the loan. Once you get approved, you should get confirmation of the promissory note. This is just terms of the loan. They should let you know how much the loan is for, how many monthly payments that you would have to make, and also your interest rate. Now let's just say that you get approved for a $2,000 share secure loan for 60 months with an interest rate of 2.25%. Your monthly payment should be roughly around $35.49. So when it's all said and done, the principal with the interest should cost around $2,116.48. The goal with this type of loan is to pay off as much as you possibly can upfront while leaving just a small balance. So if you were able to get $2,000, you would want to pay off 91% of that amount and just leave 9%. This would translate to $1,820 right off the bat, and it would just leave $180 as a remaining balance. So now we want to calculate how much you would have to pay per month to keep this account active and not pay it off prematurely. With the remaining principal of $180, you would want to subtract your monthly payment of $36, which is the safe balance, because anything less than this, the lender may just have you pay the account in full, and this is something that we want to avoid. So back to mathing this up, 180 minus 36 would equal 144. Now you want to take that number and divide it by 60. 60 months is the amount of payments that we would have to make. So now this will equal to $2.40, so we can round it down to $2. So $2 times 60 months, this will equal to $120. So with the remaining principal of $180, subtract 60 payments of $2, which is $120, this will leave you with $60 remaining. This is higher than our safe balance of $36, so you should be golden. Hopefully this is not too confusing, but essentially whatever balance that you do have, you just want to make sure that you pay enough to keep a balance high enough so the credit union or bank does not request you to pay it off early. Again, our goal is to keep this installment loan as long as possible with the smallest amount possible. Even though this is just an example, every lender may have a different criteria that you may have to meet, such as how many payments that you can make up front, so just take this example with a grain of salt. There are also some variations to this technique of when people should pay down their balance. Based off my research, it should not matter if you get approved and pay for the majority of the balance within the same day or wait until the loan hits your credit report. Some have said if you pay it off right away, the small balance will be shown as the high balance or the original amount that you had the loan for. But in all honesty, I think it's better off to pay the loan right away so you not get charged the interest if the loan is not amortized. Once you have started the process, this loan should hit your credit report within the next 30 to 60 days. Well, there you guys have it. If your credit profile is looking thin, try to implement this SSL technique to see if it works out for you. If you guys have any questions, let me know in the comments and I try to answer as much as I can. I'll see you guys in my next videos.